I'm Sean Aylmer, and this is a Fear and Greed extended interview. All the other good bits we couldn't fit into the daily podcast. If you're looking for the daily episode of Fear and Greed, check the podcast playlist. Otherwise, enjoy the interview. Some of the fastest growing economies are in what are known as emerging markets. These are less developed economies who are shifting from second or third world economies into first world countries. Many Asian nations fit into that category. Investors are forever wondering how to take advantage of the growth in these economies. Where should they put their money to get a good return in economies where companies and sectors are expanding much faster than many of their first world counterparts? There's no easy answer to that question. But to help us out, I'd like to welcome to Fear and Greed Albert Kwok, Emerging Markets Portfolio Manager at Jennison Associates. Morning, Albert.
Good morning, Sean.
So how difficult is it to earn consistent, strong returns from emerging economies?
Yes, historically, it's been very difficult to earn consistent and strong returns from investing in the emerging economies because despite all the wonderful promises that the emerging markets offer, the fact of the matter is that the returns of the EM benchmark over the past decade have been quite disappointing. Many investors started off investing in EM with the intention to access superior growth and higher returns. So they checked that box and took the risks, but all they ended up with were underperformance and higher volatility. But at the end of the day, the GDPs of the emerging economies have been growing consistently faster than the developed world. So why has the EM index underperformed the developed markets indices? So what's the disconnect? We think the root cause is that, the EM index is fundamentally flawed.
Right, so it's the index rather than the stocks themselves.
Yes, absolutely.
So just explain that.
Well, first of all, the stock market is not reflective of the overall economy because when you look at the capital market in the emerging world, it's less developed and it's not the primary means of raising capital. As a result, the stock market only represents a portion of the overall economy. And very often the breadth of the market is quite narrow. The stock market is, very often dominated by what I call the big uglies in the emerging markets. These are like the mature banks, the state-owned enterprises, the conglomerates, the oil companies, which are not the dynamic pockets of the overall economy.
That's a really interesting, I've never thought of that. So often the opportunities live outside the market as such.
Well, a lot of the exciting companies, they're private companies, but within the stock market, there are exciting and fast-growing companies as well, but it's just that they don't dominate the overall market.
So are the stock markets reflective of the overall economy in many of these emerging markets?
No, they're not. And that's especially true, in the emerging markets. Because at the end of the day, when you look at the overall stock market in the emerging world, they're dominated really by these, I would call them the slow growing, the big uglies. So I guess the point that I'm trying to make here is that you need to be very selective and you need to cherry pick the best companies within the overall market. And that would be the best way to generate above average returns over time.
Okay, so the best option to take advantage of growth trends in these different economies is to cherry pick the best companies. That means you need to be an active investor. It's not going to work as a passive investor just to buy the market. I presume you're saying you do need to be active in emerging markets.
Yes, I think it is very important to be an active investor in the emerging markets because historically, passive investing or indexing simply didn't work. The performance has been terrible. I think historically, many investors treated EM equities simply as an asset class. They would either buy the index fund or invest in funds that look very much like the index itself. We think it is actually quite a dangerous proposition to look at EM through the lens of the index. The index was, and to a large extent still is, comprised of all economy stocks, which expose investors to many potholes of the economies. The index simply fails to represent the dynamism that EMs offer. The world is changing rapidly. The old playbook doesn't work anymore, and the high tide just doesn't lift all boats. We think there is a lot of value to be added as an active investor in emerging markets.
Okay, so how do you go about being an active investor? What is it that I should be looking at in terms of investing in some of these markets?
I think experience and an intense focus on fundamental research are the keys. On average, we do about, 150 to 200 meetings a quarter. We spend a lot of time on the road and now on Zoom. We meet with the companies, we meet with their competitors, their suppliers, the customers, their early stage private investors, and even their ex-employees. Very often we would start doing research on companies, years before the IPO. So what do we look for? It all starts with the companies themselves. We look for inflection points, and usually they come in different forms like revenue acceleration or stock price actions. We would then start to dig deeper with our fundamental research efforts to identify the drivers behind them. And very often, these drivers will point us to certain bigger picture and emerging trends.
Stay with me, Albert. We'll be back with more in a moment. I'm talking to Emerging Markets Portfolio Manager at Jennison Associates, Albert Kwok. What economies do you like at the moment? Asia is in our region. That's kind of where I'm heading towards. What sorts of things are you looking for within economies in the Asian region that you would think about then going and stock picking?
Well, first of all, we employ a bottom-up strategy, meaning that we don't start identifying the regions and the markets that we want to invest in. It all starts with the companies themselves. But in the moment, we are finding most of our opportunities in China and in India. And in each of the markets, the dynamics are quite different. For an example, in China, we focus more on the long duration disruptive technologies. Because China is actually pretty, I wouldn't say mature, but it's not your typical emerging market. The penetration of e-commerce is actually one of the highest in the world. So compared to India, they are definitely on a different level when it comes to the maturity curve. So in China, for an example, what we like is what we call the next generation internet companies. These are the new players that are actually disrupting the incumbent internet giants, and they're gaining shares. Also, healthcare is another area that we like in China. On the demand side of the equation, the Chinese population is getting older, they're getting richer, and they're getting sicker. And on the supply side of the equation, many Chinese companies are actually moving up the value chain. They're moving away from the generic drugs, and they're, developing and coming up with many new innovative drugs. So we like the demand and supply dynamics there. And also we like the supply chain localization theme. As you know, the world is turning more inward looking, unfortunately. And globalization, is pretty much a thing of the past, and localization is the new trend. But we see that there are, although this is not the optimal outcome, but there are winners and losers, and there are opportunities as a stock picker.
What about India? You mentioned India just then. What are some of the opportunities in India? Huge population.
Yes, we like India as a market. I always said that India is one of the few true emerging markets left. It has a very young population. The savings rate is very high. And recently, we are also very encouraged by the economic reforms and the fiscal stimulus package put forth by the government. This time around, these programs are less so about consumption. They are targeting to improve productivities and efficiencies, which we think will have a much longer duration impact. We also like India as a big cyclical opportunity. As you know, they were hit pretty badly by COVID, and they're actually recovering quite quickly.
So how has COVID impacted investing in emerging markets?
It's interesting that you mentioned that, because we think that COVID will not only be the worst pandemic in recent history, but it will also likely turn out to be a cleansing event that brings structural shifts to the world, actually. Life after COVID will be very different from the one before. Many trends adopted during COVID, like telework and e-commerce, will be structural and not temporary. Now that the infrastructure is laid out and behaviors would be permanently changed. We will also see more emphasis and investments on healthcare in the EM economies. So I think overall, undoubtedly, the disruptions will continue, and we think that the rebalancing of the old and new economies will only accelerate.
So is investing in emerging markets, sounds to me then, is much more of a long-term play rather than a short-term play if we're talking structural changes?
Yes, absolutely. Firstly, I think, the next 1 billion consumer will be coming from the EMs. The demand potential is just humongous. Secondly, perhaps more importantly, I think we are seeing a paradigm shift in EM equities fundamentally. EM equities in the past were always thought to be driven by, commodity cycles, fixed asset investments and exports and, liquidity flows. However, increasingly, many of the EM economies are actually moving up the value chain. We are finding more and more innovations and disruptive technologies in these economies. These new innovations and technologies are actually driving the structural changes and the productivity gains that many policy reforms fail to bring. So this paradigm shift brings a whole new set of opportunities for investors. And I think this is an exciting time for stock pickers.
Of course, we haven't mentioned currency yet, but that's something to be wary of.
Yes, we typically stay away from the more vulnerable currencies and the more vulnerable economies. But since we are running a very concentrated portfolio of 35 to 45 stocks, it's much more important to pick the right stocks. Because when you pick a company, a stock that can generate multifold returns, a 10-20% hit on the currency is not a big headwind.
Just finally, those number of stocks, are they primarily concentrated in China, India, and beyond?
Currently, we have about half of our portfolio in China, but I think that is pretty consistent with the composition actually of the GDPs in the EM world. We are very much overweight in India because we think that India is a good long-term story, it's a long duration story, and also it would benefit from the cyclical upturn post-COVID.
Albert, thank you very much for talking to Fear and Greed.
Thank you so much, John, for having me.
That was Albert Kwok, Emerging Markets Portfolio Manager at Jennison Associates.